The Psychology of Investing. Chapter 1. The Emotional Investor. Emotional triggers matter because they can create a powerful urge to act before you have actually thought the situation through. In investing, that urge might come from a market drop, a scary headline, or even a private thought like, "I'm falling behind." The problem is not that you feel something. The problem is that the feeling arrives with a false sense of urgency. Your brain starts treating movement as if it were the same thing as good decision-making. But urgency is not judgment, and pressure is not proof. The goal is not to become emotionless. It is to notice the trigger early enough that the emotion does not make the decision for you. Emotional triggers are often tied to short-term events that feel bigger than they really are. A market drop can suddenly make a perfectly solid investment feel dangerous, even if nothing important has changed about its long-term value. A rally can create excitement and fear of missing out, pushing you toward buying simply because prices are already rising. Seeing a friend make money can bring up regret or jealousy, which can be just as influential as fear. Dramatic headlines make this even harder because they can turn a temporary event into something that feels permanent. In other words, your emotions may be responding to the moment, not to the actual investment case. That is why recognizing the difference between a trigger and a true change in value is such an important skill. Some triggers show up again and again because they combine surprise, uncertainty, and social pressure. Sudden price changes are one of the biggest ones, since fast drops create fear and fast rises create excitement. Intense news coverage can amplify both, especially when every headline sounds urgent. Other people's confidence can also be triggering, because strong opinions from friends, commentators, or social media can make you doubt your own plan. Personal money stress adds another layer, making normal market movement feel more threatening than it otherwise would. Even your own recent gains and losses can shape your reactions, since a recent win may create overconfidence, while a recent loss may make you unusually cautious. The more familiar you become with these patterns, the easier they are to catch in real time. Emotional reactions usually become costly through repetition, not through one dramatic mistake. Selling after prices have already fallen can lock in losses that might otherwise have remained temporary. Buying after prices have already surged often means paying more because excitement peaked at the worst moment. Trading too often without a clear reason can quietly damage returns through poor timing alone. On top of that, extra trading can increase fees, taxes, and stress, which all take a bite out of results. Over time, these small emotional decisions can add up to a much weaker outcome than a calm, disciplined plan would have produced. That is why it helps to think in terms of patterns, not isolated trades. Once you identify a trigger, the most useful move is often a very short pause. That pause creates a little distance between the feeling and the action, which is where better judgment can return. Start by noticing the emotion clearly, whether it is fear, excitement, envy, or pressure. Then ask what triggered it, because naming the source often reduces its power. Even 60 seconds can interrupt an automatic impulse to buy, sell, or keep checking your account. After that, look back at your plan before deciding what to do. The pause is not about delay for its own sake. It is about making sure your action is intentional rather than reactive. During that pause, a few simple questions can help separate emotional pressure from a sound investing decision. First, ask yourself what you are actually feeling right now, because naming the emotion makes it easier to work with. Then ask what happened just before the urge appeared. Was it a headline, a price move, a comment from someone else, or just a worrying thought? From there, bring the decision back to your goals and time horizon. Finally, ask whether you are following your own rules or reacting to the moment. These questions do not eliminate emotion, but they slow the process down enough for discipline to re-enter the picture.
Sophia gives us a simple example of what this looks like in real life.
She sees a dramatic headline about plunging tech stocks, notices one of her holdings is down 8%, and immediately wants to sell. That first reaction is fear, and it feels convincing because the headline and the red numbers reinforce each other. Instead of acting, she identifies the trigger, recognizes the feeling, and waits for 60 seconds. That short pause is enough to shift her from panic toward reflection. She reviews her long-term plan and remembers why she owned the investment in the first place. The important part is not that she felt calm right away. It is that she did not let the first emotional wave decide for her. One of the best ways to get better at this is to build your own trigger map. For 2 days, pay attention to moments when you feel a strong urge to buy, sell, or check your investments impulsively. Write down the time, what you were doing, what triggered the feeling, and what emotion showed up. Also note whether you acted on the urge or simply felt it. After 2 days, review what you recorded and look for patterns. You may notice that certain headlines, certain times of day, large gains, large losses, or other people's opinions affect you more than you realized. Once you can see your patterns, you are much more able to prepare for them. Emotional mistakes often feel reasonable in the moment, which is why they can quietly become habits. Nervousness can masquerade as evidence, making you feel that anxiety itself proves you should sell. FOMO can make a rising investment seem attractive simply because other people appear to be benefiting. Checking your portfolio too often can keep you in a constant state of emotional activation, where every small move feels important. Many investors also confuse activity with control, as if doing something must be better than waiting. But frequent action is not the same as effective action. Awareness helps you catch these mental shortcuts before they begin shaping your results. The skill underneath all of this is awareness. Emotions are real, but they are not always reliable guides to what your investments need. A short pause can keep a passing feeling from turning into an impulsive trade. Your plan, not your emotional state, should be what guides the decision. Over time, that kind of awareness builds patience, and patience supports discipline. You will still fear, excitement, doubt, and pressure, because every investor does. The difference is that you become better at noticing those feelings without handing them control. A market drop can be perfectly normal and still feel intensely personal once your own money is involved. On paper, a 10% decline may simply be a correction, something markets have done many times before. Emotionally, though, it feels less like a statistic and more like a threat. The same number that looks manageable in a chart can feel alarming when it shows up in your account balance. That shift is what often begins the fear cycle. The market is doing something normal, but your mind is experiencing it as danger. Once that happens, the urge to react can arrive very quickly. Fear in market drops often follows a predictable 3-stage pattern. It usually begins with worry, where uncertainty starts taking up more mental space and you become increasingly alert to the problem. If the discomfort grows, worry can turn into panic, and panic creates a strong desire to act right away. Then, if you sell and the market later recovers, regret appears. That is why the decision can end up hurting more than the decline itself. The original drop is painful, but the emotional reaction can add a second layer of damage. Recognizing this pattern early makes it easier to interrupt before it runs its full course. Worry is the first stage, and it often feels deceptively useful. Because it keeps your attention locked on the problem, it can feel like you are being careful or responsible. In reality, worry usually increases emotional intensity without improving the quality of your thinking. You may start checking prices more often, treating every headline as especially important, and replaying even small losses in your mind. Physical signs can show out too, like tension, restlessness, or a sick feeling in your stomach. The key point is that your threat detection system is becoming more active, but your judgment is not necessarily becoming better. Worry feels like preparation, yet often it is just stress with a financial focus. If losses continue, worry can escalate into panic. At this stage, the desire to relieve stress starts competing directly with clear thinking, and often it wins. Extreme outcomes begin to feel more likely than they really are, and your time horizon shrinks from years to hours or days. Negative news sounds more convincing because it matches the emotional state you are already in. Selling can start to feel responsible, not because the investment case has been reevaluated, but because action promises relief. This is where false urgency becomes dangerous. A temporary decline starts getting treated like a permanent collapse, and that can push investors into rushed decisions. After panic comes the stage that surprises many investors: regret. Selling often brings immediate emotional relief because the source of stress seems to be gone. But if the market recovers, that relief can quickly turn into a different kind of pain. A paper loss becomes a realized loss the moment you sell, and the rebound happens without you. That can create a hard psychological problem, because buying back in after selling low often feels even more difficult. You may wait, hesitate, or hope for another decline that never comes. So the emotional sequence becomes drop, relief, and then regret. This is why fear-based selling can have effects long after the stressful moment passes. The fear cycle becomes especially powerful because it reinforces itself. During a drop, losses grab your attention, and bad news stands out more than usual. Your body reacts before your plan does, which makes stress feel immediate and action feel necessary. Then doing nothing starts to feel irresponsible, even if staying disciplined may be the better choice. If a regretful decision follows, that memory becomes part of the next market decline. A future drop of similar size can trigger stronger fear simply because your mind remembers the last painful experience. In that way, fear is not just about the current market move. It is also about the emotional memory you carry into the next one. One helpful distinction is the difference between fear and caution. Caution wants better understanding, so it slows down, reviews facts, and asks more questions. Fear wants quick relief, so it narrows your focus and pushes you toward escape. Both can feel serious, and both can arrive during a market decline, which is why they are easy to confuse. A useful test is to ask whether you are trying to solve a problem or just make the discomfort stop. Research tends to widen perspective, while urgency tends to narrow it. That small distinction can tell you whether your decision is coming from discipline or distress. Priya's experience shows how an ordinary decline can become emotionally heavy. She had $10,000 in a broad stock fund, and after an 8% drop, her balance fell to $9,200. The number itself was manageable, but repeated account checking and a stream of negative headlines kept increasing her stress. Over time, doing nothing began to feel irresponsible, even though no new evidence suggested her long-term plan was broken. This is how the fear cycle gains momentum. The market drop starts the process, but repeated checking and emotional reinforcement make the situation feel more dangerous than it may actually be. By the time action feels urgent, the decision is often being driven by pressure rather than perspective. Priya eventually sold at $9,200 and moved to cash, which gave her immediate relief. For a while, that relief probably felt like confirmation that selling was the right choice. But 2 months later, the fund recovered to $10,400. If she had stayed invested, the temporary loss would not only have recovered, it would have turned into a gain. Instead, fear turned a short-term decline into a lasting setback. The emotional challenge also changed shape, because now buying back in felt harder than staying invested had felt before. This is the painful pattern of relief now and regret later. There are several common mistakes that keep the fear cycle going. One is confusing fear with caution, assuming that a strong emotional reaction must be a sign of wisdom. Another is trying to predict both the bottom and the rebound, which is much harder than it sounds and often leads to missing the recovery. Investors also treat temporary losses as if they were permanent, especially when emotions are running high. And many assume cash has no risk, forgetting that inflation and missed growth matter too. These are not beginner mistakes. They are human mistakes. Recognizing them does not make fear disappear, but it gives you a better chance of interrupting the cycle before it shapes your decision. A useful way to prepare for market fear is to reflect on a recent moment when you strongly wanted to escape discomfort. It does not have to be about investing. Think about what first made you uneasy, what made the situation feel urgent, and what you did or almost did in response. Then look at what happened afterward. Did your action actually solve the problem, or did it mainly end the uncomfortable feeling for a while? That distinction matters because the same pattern often appears during market drops. If you can recognize your escape response in everyday situations, you are more likely to notice it when money is involved. Fear is only half of the emotional story in investing. Quick profits can be just as powerful because they create excitement, urgency, and the feeling that a rare opportunity is about to slip away. Greed, in this context, is not just wanting money. It is wanting more money faster, with less patience than sound investing usually requires. FOMO and overconfidence often join in, making risk look smaller and reward look larger. A fast-rising investment starts to feel like proof that action is obvious. That emotional pull is why so many risky ideas look most attractive right before they become most dangerous. When greed takes over, judgment narrows in a very predictable way. Attention moves toward the upside and away from the downside. So the possible reward starts filling the whole mental picture. Research becomes easier to skip because it feels slow compared with the emotional momentum of the opportunity. Fundamentals may get ignored because the story and the price action feel more compelling. Investors may also put too much money into one idea, since confidence rises faster than evidence does. In the process, normal rules begin to feel optional. Greed does not always sound reckless in your own head. Often, it sounds like confidence mixed with urgency. Fast gains are attractive, partly because they look like strength, but they often come with equally fast downside. A sharp rise in price can reverse quickly, especially once excitement spreads and late buyers rush in. That means the people buying last may be paying the highest prices just as early buyers are beginning to sell. In other words, what feels safe because it is rising may actually be becoming riskier. Big short-term gains are rare, and when they do happen, they often involve more uncertainty than people want to admit. A fast move up is not proof of quality. It is often a signal to look more carefully at risk. Greed-driven decisions often unfold in a pattern. First, a hot opportunity grabs attention, usually through a dramatic price move or an exciting story. Then, excitement and FOMO begin building, especially if other people seem to be making money. As emotions rise, analysis starts to fade into the background, and basic questions go unasked. That is when too much risk gets taken, whether through oversized positions, poor diversification, or no clear exit plan. If the hype later fades, losses can grow quickly, while hope delays reassessment. Recognizing the cycle early is what gives you a chance to step out of it. Greed does not only affect buying decisions. It also changes how investors sell, or fail to sell, after a gain appears. A rising price can create the feeling that more profit must be just ahead. So a reasonable exit starts to look premature. As a result, investors hold longer than their plan or risk tolerance would normally justify. They reassess risk too late because the paper gain feels like a reason for confidence instead of a reason for discipline. Then, if the price reverses, those unrealized gains can shrink very quickly. Greed often whispers that taking a profit means missing something better. Maria's story shows what greed can look like in practice. She sees a small tech stock rise from $10 to $30 in just 3 weeks, and the speed of the move becomes part of the attraction. Then, she hears claims that it could reach $100, which turns a speculative idea into what feels like a life-changing opportunity. Excited by the upside, she invests her full $5,000 without doing meaningful research. She puts all her savings into a single stock and has no clear exit plan if things go wrong. Notice that the emotional focus is almost entirely on what could be gained. The usual safeguards of analysis, diversification, and position sizing are pushed aside by hype. At first, Maria's trade seems to confirm her decision. The stock rises to $35, and that early gain increases her confidence. Because the trade is working, she decides not to sell, and begins treating the success as validation rather than good fortune mixed with risk. When disappointing earnings arrive and the stock drops to 20, she dismisses the decline as temporary. Later it falls to 12, and her $5,000 is worth only about $2,000. This is one of greed's most painful effects. The same emotion that gets someone into a risky trade can keep them from exiting when the facts worsen. What began as excitement turns into hope, and hope delays action. The line between speculation and real investing is not whether an opportunity is risky. Plenty of legitimate investments carry risk. The difference is whether the idea can stand up to analysis. If the main appeal is excitement, urgency, and stories of easy money, you are probably leaning towards speculation. Real investing asks for evidence, a view of the business, some sense of valuation, and an understanding of the risks before money is committed. That does not guarantee success, but it creates a more grounded decision. A good question to ask is simple. Am I buying this because I understand it, or because the story feels too exciting to miss? Greed usually shows warning signs before it produces a major mistake. Past gains may start to feel like a guarantee, as if recent success proves future success. Hot tips and exciting stories may begin replacing your normal analysis. FOMO can override your process, making your own rules feel like obstacles rather than protections. One idea may start receiving too much money because confidence outruns discipline. And often there is no exit plan at all, which means the emotional state at a future turning point will decide what happens next. Any one of these signs deserves attention, and several together should be treated as a serious warning. The best defense against greed is structure. You do not need to eliminate excitement to invest well, but you do need a process strong enough that excitement cannot make the decision for you. That means setting rules before you buy, deciding how much risk you are willing to take, and defining the conditions under which you would sell. It also means using research and position limits so that one emotional idea cannot dominate your portfolio. Structure turns vague good intentions into practical guardrails. Emotion will still be present, but the process stays in charge. That is what protects you when a tempting opportunity feels urgent and irresistible. Greed often begins with something that feels good, and one of the strongest sources of that feeling is a gain. A profitable trade can do more than increase your balance. It can activate the brain's reward system and make the experience feel exciting, satisfying, and motivating. Dopamine is closely tied to anticipation and reward, so the gain can leave behind a strong emotional impression. Over time, your brain may start linking that positive feeling with the behavior that came just before it. That is how trading can start to feel rewarding in itself, separate from whether the decision was wise. And once that connection forms, it can shape future behavior in subtle ways. After a win, dopamine responds to the reward, not to the quality of the decision that produced it. The brain notices the positive outcome and can quickly turn it into a feeling of being right. Confidence rises, often faster than evidence does. That is why one good result can feel like proof of skill, even when luck played a large role. A gain produced by discipline and analysis can feel very similar emotionally to a gain produced mostly by chance. The danger is not enjoying the win. The danger is letting the feeling of reward become a conclusion about your ability before the evidence supports it. Once that confidence starts building, judgment can begin to slip in ways that are hard to notice. Risk review becomes easier to skip because the recent gain makes everything feel more under control. Position limits may suddenly seem less important, as if success has earned the right to take more risk. Exit plans can also get ignored because the focus shifts away from process and toward repeating the good feeling. This is a subtle transition. It does not usually feel reckless in the moment. It feels like confidence, even though the real shift is from disciplined thinking toward excitement-driven behavior. If this pattern goes unrecognized, it can become a cycle. A gain creates excitement, and that excitement boosts confidence. Confidence then leads to bigger risks, often without a matching increase in analysis or evidence. But the emotional high fades quickly. And when it does, there can be a temptation to chase another gain to recreate the feeling. That is how investing can start to resemble gambling, not because the assets are identical, but because the emotional mechanism is similar. The person is no longer just pursuing returns. They are also pursuing the emotional reward that came with the last win. A warning sign appears when the reason for a trade shifts from long-term logic to the thrill of being right. Larger positions get taken without new evidence. Trades happen more quickly and with less research. Hype starts replacing analysis because the exciting story feels more emotionally important than the underlying facts. In that state, the investor may not even be trying to build wealth in a disciplined way. They may be trying to recreate the emotional charge of the last successful trade. That is when investing starts to look like gambling. The behavior may still wear the language of investing. Jamie's experience begins in a very ordinary way. Jamie buys a popular technology stock at $50 and sees it rise to $60 within a week, a quick 20% gain. That kind of result feels energizing and rewarding, which is a completely human response. Jamie starts checking the account more often, wanting to see the gain again and watch what happens next. Up to this point, nothing is necessarily wrong. A profitable trade and a good feeling are not problems by themselves. The risk comes in what that feeling encourages Jamie to do next. The mistake begins when Jamie treats the first gain as proof of skill. Without doing new research or building a clear plan, Jamie buys more shares at a higher price. Then Jamie adds a riskier stock based largely on social media excitement. The issue is not that the original trade made money. The issue is that one result is being used to justify more risk without fresh evidence. Excitement has replaced discipline, and confidence is now coming from emotion rather than process. This is a classic example of how a gain can distort the next decision. A disciplined response to a gain begins with a different question. Why did this trade work? Instead of immediately adding risk, review the original thesis and ask whether the result actually fit the plan. If the gain was expected and your rules call for it, rebalancing or taking some profits may be appropriate. If the gain was mostly luck or happened for reasons you did not anticipate, that matters too. The goal is to separate a good outcome from a good decision. A positive result does not automatically justify more exposure. Discipline means requiring new evidence before taking new risk. Several common traps appear after a win, and they all come from allowing the positive result to drive the next decision. One is mistaking a single win for skill, which can create overconfidence very quickly. Another is chasing the next emotional high by seeking another fast trade rather than a sound setup. Rules and limits may begin to feel unnecessary, especially after success makes you feel more capable than usual. Compulsive price checking can also increase, keeping your attention fixed on short-term stimulation. These traps are easy to miss because they are wrapped in positive emotion. But a gain can be just as behaviorally dangerous as a loss if it weakens the process that protects you. One simple defense is to build a pause after every profit. Even a short reflection can interrupt the reward loop and shift attention back to process. Ask yourself how the gain made you feel and whether it created an immediate urge to trade again. Then, ask whether the result came from a repeatable process or mostly from luck and favorable timing. Finally, consider whether repeating the same behavior would likely work over the long term. This kind of pause helps separate discipline from dopamine. It keeps a good outcome from automatically turning into a risky follow-up decision. One of the strongest forces in investing is loss aversion. The tendency for losses to feel more painful than equal gains feel pleasurable. A $100 loss usually hurts more than a $100 gain feels good. That imbalance is deeply human, and it does not mean anything is wrong with you. But in investing, this instinct can quietly work against you because markets naturally involve temporary declines. If losses feel emotionally heavier than gains, your decisions can become distorted even when the numbers are still manageable. You may react not just to the money, but to the emotional weight attached to the money. That is why understanding loss aversion is so important for investor behavior. What makes loss aversion so important is that the real damage often comes from the reaction, not the decline itself. Temporary losses are a normal part of investing, especially in assets that offer long-term growth. But the pain of a loss can trigger fast decisions, avoidant decisions, or defensive decisions that are not truly grounded in the facts. Emotion starts shaping what happens next. Someone may sell too soon, freeze completely, or take a reckless action just to escape the feeling. In many cases, that reaction ends up doing more harm than the original market move. So the behavioral risk is not just the loss. It is what loss aversion pushes you to do after the loss appears. Loss aversion tends to show up through a set of common emotional reactions. Panic is one of the clearest, where the person wants to sell quickly just to stop the pain. Paralysis is different but just as important, because sometimes the response is to avoid action, ignore the account, or freeze. Regret can take over too, causing someone to replay the decision and hesitate the next time an opportunity appears. Guilt may make the loss feel like a personal failure, while resentment can create anger toward the market, the investment, or even yourself. Naming these reactions matters because unnamed emotions are more likely to control behavior. Once you can identify the emotion, you have a better chance of interrupting the pattern. These emotions often lead to different behaviors, but the underlying pattern is the same. Emotional pain creates pressure, and that pressure pushes behavior in ways that can weaken long-term results. Panic may lead to selling too soon and locking in losses. Paralysis can delay rebalancing or other thoughtful changes that actually should be made. Regret can keep you out of future opportunities because you do not want to risk feeling that pain again. Resentment may fuel revenge trading, where the goal becomes emotional payback instead of good investing. Even guilt can push someone to hide in cash for safety, only to miss future growth. The emotion feels personal, but the cost often shows up later in portfolio results. Loss aversion often follows a familiar chain. First, a loss occurs, whether realized or just visible on paper. Then the brain registers threat, and the emotional impact becomes larger than the numbers alone would suggest. The loss starts to feel heavier, more dangerous, and more urgent than it may actually be. Fear or some other painful emotion takes over, and behavior begins to change. That behavior might be panic selling, freezing, overchecking, or abandoning the plan. If the outcome is poor, the experience can reinforce the pattern and make future losses feel even more threatening. Seeing the sequence clearly is what helps you interrupt it before the behavior stage takes over. Maria's market decline shows how a temporary drop can become a lasting setback through panic. Her portfolio falls from $50,000 to $40,000, a 20% decline. Financially, that is painful, but emotionally, it feels like danger rather than normal market fluctuation. She sells everything and moves to cash, which stops the immediate stress. But when the market later recovers, she misses the rebound. If she had remained invested, the value would have climbed back toward $48,000. But in cash, she locked in the lower amount. The original decline hurt, but the panic response made the damage more permanent. Maria's story teaches an important distinction. The lesson is not that declines never matter, or that every drop should be ignored. The lesson is that loss aversion can intensify the pain so much that it drives a hasty decision. The market decline created the initial problem, but the emotional reaction made the outcome worse. That same pattern can take different forms in different people. Some panic, some freeze, some later feel regret, and some respond with resentment. What they share is that behavior becomes driven by pain rather than by a disciplined plan. Understanding that difference is one of the foundations of steadier investing. Of course, not every sale or reduction in risk is a mistake. Sometimes a defensive decision is completely appropriate. The key question is whether the choice reflects a real change in your goals, time horizon, or the investment's fundamentals, or whether it mainly reflects a desire to escape discomfort. A disciplined review asks what actually changed. Did the facts change, or just the feeling? Risk limits and portfolio rules should guide the action, not raw emotion. Selling to relieve pain may feel similar to risk management in the moment, but they are not the same thing. One is a plan-based response, the other is an emotion-based escape. Loss aversion distorts judgment in several predictable ways. One common mistake is treating any loss as proof that you failed, which turns a normal investing experience into a personal judgment. Another is allowing one bad experience to reset your whole strategy, even when your long-term goals have not changed. Some people try to avoid loss completely by hiding in cash or becoming so conservative that growth becomes unlikely. Others hold losing investments too long because selling would force them to admit regret or accept the loss. These decisions often begin with emotion and get justified afterward with logic. Recognizing that sequence can help you question the story before acting on it. A short reflection after a paper loss can help you spot your own pattern before it affects a bigger decision. Start by describing the loss clearly and simply, without dramatic language. Then, name the first emotion you felt, whether it was fear, regret, anger, or something else. Write down what action followed, even if that action was only checking your account repeatedly or avoiding it completely. Finally, ask what a disciplined plan would have done in the same situation. The point is not to judge yourself. The point is to see whether your response was protective in a rational way or mainly emotional in the moment. That kind of awareness is often the first step toward better decisions. The key takeaway is that loss aversion is not just a thinking error. It is an emotional force that can shape behavior in very costly ways. Losses can trigger panic, paralysis, regret, guilt, and resentment. And each of those emotions can pull you away from your plan. In many cases, the reaction ends up hurting more than the original decline. That is why awareness matters so much. When you can recognize the pattern early, you create room for a more disciplined choice. And in investing, that space between feeling and action is often where better outcomes begin.